Welcome, everybody. I guess the first question I usually ask, just to know how fast or slow I go through the slides, is how many people have seen my presentations before? Yeah, obviously Y for yes, N for no. Whoops, am I getting responses? Just have one. Okay, so a lot of people right now showing a lot of people haven't. Okay, my name is Steve Bigalow. I've been investing, unfortunately, over 40 years. I was a stockbroker with Kidder Peabody Cowan and Company and Oppenheimer way back in the early 70s and 80s. Got out of the business because I found out that they had no more inclination of what made prices go up or down than anybody else. So I got out of the business, and then somebody dropped candlesticks on my desk. So unfortunately, for those that haven't seen this, I'll kind of show what we're going to be doing today. We're going to be looking at the Bobble T-line crunch. Candlestick signals are the graphic depiction of everybody buying and selling investor sentiment so it's the most consistent indicator in the world because investor sentiment doesn't change. So the Bobble and T-line crunch are very powerful, high probability trade setups. And one of the aspects that we use in our investing is what we call the T-line. It's the 8 exponential moving average. There's a very simple formula for the 8 exponential moving average. There's a very simple concept, which is that the candlestick signals, if you see a candlestick buy signal and a close above the T-line, you consider you're in an uptrend until you see a candlestick sell signal and a close below the T-line. Now we call it the T-line because it's the trigger line, but the aspect that it works like a Fibonacci number is very important. Everybody has the moving averages on their charts, like the 50, the 200, the 20, so they act like magnets. But nobody has the T-line on their chart. So that's when it moves back to that level and works as that level as a very effective support and resistance. It's a natural support and resistance of human nature. So what it boils down to is if you've got the graphic depictions of what's going on in human nature with candlestick signals, and you apply the T-line, which is the natural support and resistance level of human nature, you now have a very powerful combination. So what we're going to show as far as graphics, no matter what your trading program, whoever you're following, whatever type of trading you're doing, if you throw candlesticks on your charts, it's going to make everything that much more clear. So anyways, the high profit patterns with T-lines is very simple. We've got what we call the J-hook pattern. Notice here's our T-line. This is the 8 exponential moving average. These are what we call J-hooks. And the reason we can identify them much more clearly than everybody else is that notice when it pulls back, they couldn't close below the T-line. So if we took profits up here, and there's one aspect of the T-line that we always follow, which is the further away you move from the T-line, the higher the probability is going to come back and test it. So if we're taking profits, we get back in here until it's time to take profits and get back in. The J-hook pattern is a very reliable trade setup. So we're looking at the transportation index today. Look what it's doing. First of all, it's doing one of the strongest candlestick signals, which is the kicker signal. Notice how yesterday it opened here and closed here. Today they gapped it up and went the opposite direction. That's called a kicker signal. It means the investor sentiment has been kicked in the opposite direction. This is one of your most powerful signals. And if you can apply it also, that we know that there's probably more upside to the pattern, the J-hook pattern, that tells us we've got a high probability that things are going to continue to move higher. So we're watching ORBC, same scenario. If it breaks out through this level, there's a very simple calculation for the J-hook pattern. Wave 1 and wave 3 are usually going to be the same magnitude. So even if you miss this move and you see this pattern set up, you know what the magnitude of this move will be. Same as this move, which does two things for you. One, it lets you calculate whether this is going to be a worthwhile trade, number one. And number two, if you're an option trader, you can not only just set up call strategies, but call spread strategies or put strategies. So there's different patterns in candlesticks that become very effective when we know that what a fry pan bottom, this is what we call the classic pattern. We're in this one trade right now because here's your classic pattern, which is a fry pan bottom. We know what the results of a fry pan bottom are. It's usually a breakout to the upside, give you a very strong price move. We know what the prerequisite for a J-hook pattern is, a very strong price move with some consolidation. And we can see the consolidation is not hard selling. Notice the dojis. These are one of the 12 major signals. And a doji basically indicates that there's indecision between the bulls and the bears. So if you've got a strong price move and it's trying to pull back and show an indecision, it means it's not pulling back with any great resiliency. Get ready for the next move to the upside. Uh-oh. So if you take the Bobble pattern, which is a much more refined pattern, it's when it hits a resistance level and then starts pulling back to the T-line. If it supports on the T-line, if you took your profits here, because if you cut the chart off, basically we've got a candlestick sell signal on a major resistance level, take our profits, but notice what it can't do. They can't close this below the T-line. We're buying back on the Bobble breakout because this is just a much more defined J-hook pattern telling us where the resistance level was and where to get back into the trade. So the T-line acts as support when it pulls back. This is our support level. This is what we're watching. Anytime we see something that's providing a sell signal and we close out the position, we can see whether it's time to get back into this trade. The fact that we know what the different candlestick signals represent, like right here, we have a bullish day, a doji, and another bullish day. That's called a doji sandwich. And we know the results of a doji sandwich. There's going to be more upside. So even if we took profits here, we can be buying back here, knowing that the next wave is in progress. So anytime we see a sell signal, we take profits. When it comes back up through the resistance level, we're back to buying, looking for the next resistance level. So when we see something like this, what is expected? To see if it's going to do a Bobble breakout. Anytime we see a resistance, again, the J-hook pattern is much more defined, getting ready for the next price move. A Bobble pattern. Failure, T-line pushes it right back up through the resistance. You can be buying back at this point. So this is not a very difficult process. All you have is a candlestick buy signal, a close above the T-line, a resistance at the first resistance level, a pullback, and then comes back up through the resistance level. It may be 3 days, it may be 3 weeks, but when you're selling here, this becomes now your buy point as it comes back up through. Again, a J-hook pattern, Bobble pattern. So it's whenever a resistance level is breached, it usually will come back and be tested as support. So when we see something like this, where something comes up through the T line and comes back and finds a support level, the advantage we have, what is the blue line? The red line is the 200-day moving average. The blue line is the 50-day moving average, and the gray line is the 20-day simple moving average. These are all simple moving averages because every money manager around the world uses those moving averages to make their decisions about their portfolio. We have the advantage to see exactly what investor sentiment is doing when it at these levels. The black line is the T line, and then for another training session, the green line is what we call the 3T line, which is that if you're moving too far away from the T line, the 3T line becomes much more effective. But anytime we see these situations where the T line is acting as a support, they come up through a resistance level, and then they pull back to the T line and the resistance level, we have a much more clear indication of whether they're profit taking or whether that was just consolidation at those moving averages. Again, here's our belt hold signal, one of the major patterns in candlestick analysis. Breaks up through, and just like any other indicator, the further away you move from the 50, eventually they move it back to the 50. There's our evening star signal. One of your 12 major signals is a sell signal, and a close below the T line. That told us if we were long, we should be out of this trade right here. Now we can be going short until when? Until our stochastics, which my stochastics are set at 1233. In the oversold area, we're seeing buy signals here right off the 50-day moving average and a close back up above the T line. Again, there's our J-hook pattern. So basically what this does is just gives us a much more clear indication of what type of investor sentiment movement is going to be occurring in any price trend. Came up through the resistance level, pulled back to the, and again, this is our morning star signal, right smack dab on the 50. That tells us we can start buying. This is another feature of candlestick analysis. The basic function of candlestick charts is what the Japanese rice traders put into a graphic depiction of what usually happens in human nature. Where do most people sell? They panic sell at the bottom. Where do most people buy? They buy exuberantly at the top. Fortunately for me, being the worst investor in the world before candlesticks came along, I knew I was the one selling down here and wondering, how come the day I sell, they take it right back up? Or the day I buy, they start taking it back down. That's because that's what happens in human nature. So all I had to do is to reverse my analysis 180 degrees and start looking for buy signals in the oversold area and start looking for the sell signals in the overbought area. So there's our kicker signal up through our resistance level. And notice how the 50 right now is acting as, would be acting as support. We can be buying this one on strength. There's our bobble. Pulls up to the resistance level. In this case, notice how the stochastics, not quite in the overbought area, told us the 50 was not going to act as resistance. That pretty much gave us an indication that that we were heading for the next resistance level, the 200-day moving average. Remember, our doji in the overbought condition tells us to start looking for a sell signal. And there's a very simple rule of the doji. If you're in the overbought area and they open it lower the next day, you take your profits immediately. And then notice what happened right back here on the 50. Again, these are candlestick signals. There's a hammer signal followed by a bullish harami. The bullish harami basically tells us the selling has stopped, and we can see exactly where the selling has stopped, right smack dab on the 50. We're ready to buy on the next trade setup because now we're looking for the next move to the upside. So the difference between a bobble and what we call the T-line crunch, the T-line crunch has an obvious element to it. It didn't hit a resistance level. Once we saw the buy signal, again, here's our bullish engulfing signal after inverted hammers in the oversold area. We have a close above the T-line. We can be buying. How long do we stay long? As long as we don't see a sell signal and a close back below the T-line. And the T-line crunch is, everybody can see this is a resistance level. But if they're pushing this right up through the resistance level, that's called a T-line crunch, that they can't close it below the T-line and they're pushing it through the major resistance level. We're watching from down here to see whether it's time to sell at that resistance level or continue to hold. And I forgot to add in here, if you've got questions as we're going along, don't be afraid to ask. I can answer them as we go. So the T-line crunch, once the buy signal occurs, keeps us in this position. Even though we see candlestick sell signals, we don't see a close below the T-line. That's the criteria for closing out a long position. You want to see a candlestick sell signal and a close back below the T-line. So the T-line crunch is different. It doesn't necessarily have to hit that resistance level. All it has to do is keep the we have the T-line crunch pushing us up through the 50. Now here's why candlestick analysis is so beneficial based upon what happens in human nature, is that notice we had a doji day right smack dab on the 50. And what's our simple doji rule? They're going to move in the direction of how they open after a doji. When they open up positive, what's that telling us? It's telling us they're confirming the doji rule, number one, and number two, telling us they aren't going to resist here at this level. Had this opened lower based upon our doji rule, we would have taken profits because that would have told us the 50 was acting as a resistance level. The fact that they broke through told us now we're looking for the next resistance level. If a stock is trending upward far above the T-line, then is it wise to take profits when it closes below the T-line, to the 3T line? Yes, the 3T line will be more effective, but more beneficial is that everything we do is on the predicated on what is the signal telling us. So the fact that you might be way above the T-line is your first alert to start watching for a reversal signal, because we know that the further away you move from the T-line, the higher the probability it's going to come back down and test it. So if we're way above the T-line and we see a sell signal, we can get ready to start taking profits. And then see what it does when it pulls back to the T-line. Now, the 3T line also is effective, that the further away you move from the T-line, the 3T line becomes more effective in the sense that if you see a sell signal and they are starting to trade it back down through the 3T line, yes, you want to be taking profits because more than likely they're going to come back to the T-line. Well, for crying out loud, the phones are just ringing off the hooks here. So right now on this one, we would be watching to see what was happening right here at the 50-day moving average resistance level. If it opens positive, we know we've still got an uptrending stock. If it opens lower and closes below the T-line crunch, we close out the position because that basically tells us that the 50-day moving average is acting as a resistance level. The black line is the 8, yes, the 8 exponential moving average, the T line, and the little green line is the 3T line. So the resistance level doesn't necessarily have to be a moving average. All it has to do is be a resistance level that you can see. And that's once again, the benefit of candlestick analysis is whatever you're looking at, whether it's a Fibonacci number, a trend line, a moving average, anything that everybody else is watching, we have the benefit of seeing what they're doing at that level. So a T-line crunch can still work effectively based upon any type of setup for a resistance level. So in this case in Plaque, where we could kind of see there was a trading trend level, and we saw a buy signal. Notice what had happened prior. This is again, this is just simple observation. Moved down, moved up, moved down, moved up, and then couldn't get back below the T line when it did a bullish engulfing signal. Told us they weren't taking it back down. There was probably a new dynamic now in this position. Same scenario here. Here's our bullish engulfing signal with a bullish doji sandwich. What do we expect from a doji sandwich? For it to move positive from there. And we can also see, this is a whole different training, but we can see the flat trading right here. Then what we call the scoop pattern. And if they break out, what do we expect coming out of a scoop pattern? A strong slingshot effect. And we go back, once that move is starting, we go back on the same basis that as long as they can't close this below the T line, it's telling us we want to stay long. Now look how the T line crunch, they opened it here and closed it here. They couldn't close it below the T line. That tells us more than likely there's more upside. We can stay long on this position. Morning star signal in the oversold area, close above the T line, followed by a doji sandwich. What do we expect coming from a doji sandwich? More upside. And what type of pattern? This is what we call a fry pan bottom. But we can see whether we should stay in this fry pan bottom as long as we stay above the T line. And there goes your T line crunch again, pushing you up through the 50. So if we were buying here and wanting to know whether we should be taking profits here, we know that everybody and their brother is watching to see what's happening at the 50-day moving average. We can see based on our graphics that there was no resistance here, that more than likely now this becomes our next target. So again, this is not rocket science. This is merely taking the graphics of what the Japanese rice traders have provided for us over the last 400 years, and not only giving us patterns that human nature usually repeats time after time, but they also explain what the psychology was to create those signals or patterns. Nijar, whether you want to use the 9, the 10, the 8 simple, it doesn't really matter. Do whatever you want to test. We have been using the T-line for quite a few years now. And the nice thing about candlestick analysis, as you can see, the charts aren't very difficult or very cluttered. So the basic analysis of candlestick signals is that they work, or we wouldn't be looking at them today, which also allows us to put whatever we want to add on to a chart to test it. We know the basic of candlesticks works. Then whatever else you want to put on there to see if it's going to improve the probabilities, you just put it on there. And if it doesn't help any, you take it right back off. But the underlying criteria of candlestick analysis is, it is the graphic depiction of investor sentiment, of human nature, that has worked for the last 400 years, and it's going to work for the next 400 years. Investor emotions do not change. All we're doing is looking at the graphic depiction of those investments. So essentially what we're looking for is high probability setups. This is one of the positions we're in right now, VRX. We could see the big fry pan bottom setting up. This is what we call our bullish flutter kicker signal. A bullish flutter kicker signal is basically a kicker signal with a opens here and closes down here, dark candle. The next day they gap up above the previous day's open, but do a doji type day. So it's not real compelling. But once again, what is our simple rule of the doji? They're going to trade it in the direction of how they usually open it after a doji. So on a positive open, we're buying immediately because we know the probabilities are that if they did a doji and open it positive, it's going to trade positive. The bullish kicker signal is one of your strongest signals. The bullish flutter kicker signal is basically a bullish kicker signal with this little flutter in between. If you took this doji out of here, you essentially have a kicker signal. And if you've got a kicker signal that's indicating there's going to be more upside, that's now confirming that this big fry pan bottom is ready for a breakout to the upside. So we've been long VRX, and this does two things for us. Whether you're buying the stock or you're trading options, this gives you the ultimate entry points of when to get into a trade. That you're seeing the confirmation of a doji bullish flutter kicker, we're buying immediately on a positive open the next day, which does two things as far as trading options. One, with a trading like this, most people are saying, it's not doing anything. The premiums aren't very big in your options. We're buying at a point where we know it's the optimal point to get into a trade, number one. And then number two, the premiums aren't all that big. So we're getting in, and once it starts moving, we got two things going for us. One, the intrinsic value starts building up, and two, that the premium value starts adding on. So it double kind of enhances our profitability almost all that much greater. Anytime we can see where there's a resistance level, Kara, for example, we could see it was kind of lethargic for crying out loud. I gotta turn the ringer off. We could see where the resistance level was, and then notice what we had here. This is the big bullish engulfing signal. Oh, man. So this is a bullish engulfing signal that has actually followed a doji, which is called a left-right combo. This is one of the doji signals and patterns that work extremely well as far as a very powerful trade situation. So once this broke out, this told us there was a completely new investor sentiment in this trade. Not only a new investor sentiment, but the left-right combo is a very powerful bullish signal that told us we could be buying on this day or this day because there's a new dynamic in this trade. So essentially, what signals do for us is just point out where there's been a dramatic change of investor sentiment, and they do it with signals. So we're right now currently long in edit. Notice what we had down here. This is your bullish Harami followed by a gap up. And this is a whole study that we do for candlestick trading, is anytime you see a signal in the oversold area and they gap it up the next day, not only does a signal tell you that there's probably a reversal, but when they gap it up, the reversal is going to be very strong. So how long do we hold on to this? As long as we don't see it close back below the T-line, and basically we're involved with a T-line crunch in this situation. SIG was a recommendation yesterday. once again, we're looking at a situation. There's our bobble, a failure at the 50. When it pulls back, there's our morning star signal, one of the 12 major signals. Then it came right back up to this level. We can see what's setting up as a J-hook pattern bobble. So what do we know we can do if it opens positive the next day? We know that we've got an extremely high probability that we're going to be trading higher. How much higher? We don't know, but it puts us in situations where we're in at the exact right time. So we were buying calls right here as soon as it opened positive, because that told us two things. One, the 50-day moving average was not going to act as resistance anymore. And two, a J-hook pattern was in progress. And what is our upside potential? Well, if wave 1 and wave 3 are basically the same, we are buying the July 60 calls at $3 because our next target, if we extrapolate this move out as this, is up to 72. So our $3 should go into the $12, $15 area. For moving averages, we generally use simple and exponential. How much is it significant for weighted and triangular? Aim it, that's up to you. We're not trying to calculate what's happening based upon the simple moving averages. We're just visualizing, or we're seeing what's the moving averages that everybody else is using to make our decisions or be able to see exactly what's happening there. So we're not using the 200, the 50, or the 20 simple moving averages because we're using the 200, the 20, and the 50 simple moving average. We're using it because we want to see what everybody else is doing at those moving averages because they use them. The weighted moving average is now a completely different trading technique. All we're doing, the number one criteria is looking for the buy signals and the patterns that reoccur time after time in candlestick analysis. It doesn't have to be exact. If I can calculate that this came from, let's say, 47 up to 61, I can figure this out. That's about 13 points. 13 points from right about in here tells us we're looking for approximately the $72 range. And again, this doesn't have to be exact. It's just giving us a range of where we expect the price move to move to. Now, if we see a sell signal right here and it reverses, our number one criteria for any trade is what are the signals themselves telling us. So anyways, this puts you in situations. This is the whole point of examining these different patterns, like the Bobble pattern. It puts us in high probability trade setups right from the get-go. So I guess that's about all I got on the Bobble and T-line crunch. I think we were supposed to have a, Pshaw, let me see if I can find the, here's the, we have a link, if I can grab it. And I don't know how to put it in here. Oops, I'm trying to. Hold on for a second. Renee, what do I do? Send to all. I guess I can do it this way. Okay, it's over on the left-hand side. What we've got is a little special for the Bobble pattern. So that you can, and I'm also think that with that $17 you get a trade setup or a free trial period for our website. Our website's candlestickforum.com. We usually have a chat room every day going while the markets are open. And we've got about 150, 200 people in there on any given day. But the nice thing is you've got plenty of people that are familiar with candlestick signals, so you can ask questions and learn how to use candlesticks. And as I mentioned before, no matter whose trading technique you're using, if you just apply candlesticks over what they're doing, you'll see much more clearly what's happening on your charts. Does the stochastics factor into your decision to enter next to the trade? Yes, obviously a candlestick buy signal in the overbought condition doesn't mean very much, or a candlestick sell signal in the oversold area doesn't mean very much. What you're looking for is a candlestick buy signal occurring. Let's see if I can get to one. You're looking for candlestick buy signals, which this one's cut off. Candlestick buy signals occurring when the stochastics are in the oversold area. If I'm a beginner and these tips are really helpful, I will apply them to Forex trading. Yes. Remember, candlestick analysis is merely the graphic depiction of everybody buying and selling during a specific time frame. It doesn't matter whether you're trading stocks, bonds, futures, currencies, tulip bulbs, anything that has fear and greed. Candlesticks is merely the graphic depiction of what's happening in those price moves. So I trade stocks on a swing trade basis, meaning my trades last anywhere from 2 to 10 trading days. I'll trade intraday. I might trade soybeans or the dollar or live cattle on an intraday basis, meaning I'm usually trading those off the 10-minute chart. I used to trade the E-minis off a 1-minute, 3-minute, 10-minute chart combination. So every chart you look at, this chart will look exactly the same. This could be a 1-minute chart. This could be a 10-minute chart, an hourly chart, a weekly chart, or a monthly chart. They look exactly the same. Again, because this is just merely the graphic depiction of what's happening in investor sentiment. Let's see, did everybody get the link over on the? So again, for the $17, oh, I'm supposed to explain that. For the $17, again, we have our chat room open every day. We've also got an options and futures room where the conversation is more on what type of chart patterns are setting up and what would be the best option strategy to apply to that chart pattern. Every Monday night, we do a session where we look at what is happening in the markets, which futures are moving the best. Is the biotech industry the best, which would be an analysis of Labu? Is the oil sector a good sector? We can analyze instantly on each chart what each commodity is doing. Right now, looks like oil is trying to bottom at the $43 area, which means there might be trades now in the oil stocks. So we can pinpoint which sectors are starting to move the strongest. Thursday night, we do the same session, but it's open to everybody. Now, I put out 2 or 3 stock picks every day, and we do it in a video fashion so that it's not so that people are getting stock picks. It's so they can, in the learning process, see why those picks, what the rationale is for those picks. And we're not trying to just give picks to everybody, because it's the old adage that if you just tell somebody what to do, they're not learning anything. It's like the cop that's standing on the street corner, and he sees this drunk weaving down the street. He blows his whistle, pulls the guy over, walks up to the car, and there's a penguin sitting in the back seat. And he said, "What the heck are you doing with a penguin in the back seat?" And the drunk said, "Oh, I don't know. I found him out on the street, and I don't know what to do with him." And the cop said, "Well, take him to the zoo." The drunk said, "Oh, I didn't think of that." Well, the next day, the cop's standing on the street corner, and here comes this drunk weaving down the street again. He blows his whistle, pulls the guy over, walks up to the car, and there's the penguin sitting in the back seat. And he goes, "I thought I told you to take the penguin to the zoo." The drunk said, "I did. He liked it so much. Today we're going to a baseball game." So if you don't understand why you're doing something, it really doesn't help you any. I use stochastics of 12-3-3, and that's nothing more than one night I sat down and said, all right, if this is the bottom, where's my stochastics bottoming out? And if it's the top of a trend, where's the stochastics topping out? And that's nothing set in stone. It's just, again, over the last 40 years, it's been very instrumental as far as I said before. One time I was the worst investor in the world. When I started using candlesticks, now I can pull money out of the markets consistently. Do you have high expectations? Do you have high expectations Fibonacci reading? Julian, I don't use Fibonacci as a #1 criteria. I don't use it as a criteria at all. What I do use it for is, let's say I saw a trend and I started seeing it pull back. I want to see if it's going to pull back to the moving averages. I can flip Fibonacci numbers on. I can put anything on my chart that tells me where the reversal, if I see reversals, why it occurred at those levels. I think the question is what settings was for the stochastics. And yes, it is slow stochastics. Yeah, these are the stochastics down here, 12-3-3. Renee, how much time do I have? Are we stopping at 1?
Yeah, you have just about 2 minutes.
Okay. So anyways, again, on our website, we do training sessions on how to use candlestick signals to put the ultimate or the best stop loss indications. For 40 years, I've heard investors tell you cut your losses short and let your profits run, but they never tell you how to cut your losses short and let your profits run. Candlestick analysis is just common sense put into a graphic depiction. It tells you when to be out of a trade and when to stay in a trade. Let's see. We also do sessions on how to scan for the best trades the next day. And again, that's just putting the simple formulas for candlestick analysis into the trade analysis or into your search every night. How to improve your entry and exit strategies. There's times where you don't get into a trade when it doesn't open properly. And there's other times it shows when it's time to be out of the trade, especially if you're way above the T line and you start seeing that your stochastics are in the overbought area and you start seeing a sell signal, the probabilities say it's time to take profits. All right, so with that, it's 1 o'clock. Thank you, Renee, for having me. Thank you, everybody, for listening. Hopefully, we'll see you in the chat rooms.